Thank you very much for joining us. Your report caught our eye. When I hear something that inter-sector correlations are the lowest since just before the tech bubble burst, I get a little nervous. Tell us what your report finds, and more importantly, what does it mean?
Sure. So the chart that you're seeing right now shows the correlation of the sectors within the S&P. So how energy versus tech versus financials, utilities, etc., how the sectors react versus each other. And as you can see, that correlation is currently near a 30-year low, which is the lowest we have on history. And in terms of what's driving it and what does it mean, I would say probably the primary factor that's driving this breakdown in sector correlation is due to changes in fiscal policy. If you look at that chart, you'll notice that the breakdown in correlation really started happening late last year following the U.S. election, when, of course, Republicans took over both the White House and the Congress. And as a result, we have, for the first time in almost a decade, the possibility of significant changes in fiscal policy. And that's when investors really started having to dig deeper at the sector level to kind of pick out the winners and losers of fiscal policy. And you'll see why, for example, at the start of the year, we had a huge rally in financials and industrials, and then as the fiscal agenda stalled, that changed into tech and energy, which was kind of like the non-Trump related sectors, and now we're back to now we're back to financials, back to industrial. So I say this sector rotation, changing sector leadership, is really very much driven by what's coming out of DC and changes in fiscal policy.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.